Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Warner Brothers Discovery. Here we go again, folks. Plans to once again reject a takeover bid from Paramount Skydance. For more, we're joined by Luke Stillman. Luke is a managing director at Madison and Wall. How's this thing going to play out here? It feels like Paramount's got to come in with a higher bid at some point.
Yeah, it's an interesting development. So Warner essentially rejecting Paramount's barely improved offer, same $30 a share offer, a few extra guarantees. Yep. If they want something to move in this discussion, I think it's going to have to move up to $34, $35 a share. We're in an interesting situation here where it's hard to tell which of these bids is really the higher value one, because of course they're going after different assets. Netflix wants just the studio and streaming assets. Paramount wants everything. So understandable in that uncertainty that Warner's leaning towards Netflix, the much larger company. What I think is interesting about this is not so much the takeover commentary, but really what it says about the reset that's happening in the TV space. Yep. Distribution shifting, monetization under pressure. So all this consolidation is a symptom of that pressure, not the cause of it.
What is the strategic reason that Paramount hasn't raised its offer already? I mean, when I saw that Warner Brothers was expected to reject the bid, I immediately looked to NINSS, right? No duh, they're going to reject, because they haven't offered any more money. Just because you say Ellison's good for it and the breakup fee is a little bit higher, that's not going to move the needle. Why don't they say, okay, it's $33 a share?
Well, I think there's plenty of time here. I looked at betting markets the other day. There's a decent shot, according to them, that this drags on into 2027. So I think there's 5 or 10 new developments that we're going to get over the coming days and months, and plenty of time to potentially raise the offer.
By the way, it's interesting you bring up betting markets, and more, that's an indicator that people care about. And I wonder if it's because, does David Zaslav put down a bet? Does Larry Ellison put down a bet? Do people in the know, you think, play in these betting markets?
Well, I don't know if people in the know are playing in the betting markets, but certainly...
The thing is, Luke, you know more than everybody else about this stuff, right? So when you're looking at the betting markets, like, why do you care what these chumps are putting down on poly markets?
It's a question how deep that market is. Yeah. Like, how representative are those betting markets?
Yeah, well, look, there's lots of moving parts in this takeover battle, regulatory issues, political connections. So, again, I don't think the story's over there. You think
people in the Trump administration would be playing on poly markets?
Crazy to think so.
So, Luke, how about this?
I'm shocked to hear that there's gambling going on in this place.
Looking at this deal, it feels like it's a nice to have for Netflix, but it's kind of a must have for Paramount, because if Paramount doesn't get this deal, I don't know what they do. So how do you think about that? I mean, if I'm Paramount, I feel like I really got to stretch to get this deal.
Part of the problem in the whole TV space is really the economics don't work anymore. So we're at something we call the pay TV singularity. Right now in 4Q25 is when fewer than half of the households in the U.S. have a pay TV subscription. That's down from nearly 90% in 2010. And the economics just don't work anymore. Consumers want video more than they ever have. They spend more on video than they ever have. They're just doing it in a different way. Yep. And a lot of the gains aren't going to the streaming platforms of a Paramount. They're going to a Netflix or an Amazon or an Apple.
Do consumers care about, I go to the movies all the time, but I'm old, right? And that's because I want to do something with my wife where I don't have to talk to her. Do consumers care about going to the theater? Because if Netflix wins, the worry is that we're going to see the end of the big screen business.
I mean, theater box office receipts still haven't really recovered since COVID. We haven't seen a new high yet, even though every year we expect, everyone forecasts a new high. I think part of it is that people underestimate how engaged consumers are with streaming platforms. Every time we see a price increase or a password crackdown, everyone has a discussion about, is this too much? Is this where consumers say it's too expensive? But consumers aren't trying to save money by cutting their cable subscription. They're just moving that money over. And so for a Netflix HBO or another combination, $30, $40, $50 streaming bundles there's plenty of runway for price increases.
What's amazing here is the value being ascribed by various players in the marketplace for the cable networks business of Warner Brothers Discovery. Those businesses used to trade at 10 and 12 times EBITDA. They're being valued today around 3 to 4 times EBITDA.
3 to 4
times EBITDA.
Is that the Netflix valuation or the Paramount valuation?
Again,
because the problem is those are pretty far apart, aren't they?
Somewhere in between. Bloomberg Intelligence Geetha values them at about $4 per share. That's about 4.5, 5 times EBITDA. Less than half of what they were, 10 years ago.
And part of the problem is the TV ad business is just in permanent structural decline. So it's this $70 billion slowly melting iceberg of value that is not recovering as much as broadcasters want to brag about their streaming ad growth. It's just cannibalizing the linear dollars. It's not growing the pie.
By the way, can you weigh in on the Trade Desk issue? We were just talking with Isabel Lee about why is Trade Desk doing so badly? It's down 70% year to date. And to my mind, that's an incredibly valuable business model, right? You want to be able to aim your ads at the correct viewers.
Yeah. We just launched a programmatic ad forecast, and it is a growing space. The problem for the Trade Desk is their take rate is really high and there's new competition, so potentially some challenges there. Not to mention the open internet, like the TV marketplace, is struggling, at least compared to big search platforms and big social media platforms.
What's the AI impact on advertising, do you guys think, these days?
We think the AI impact is not much for search.
Okay.
We don't think it erodes the search business.
Well, because I could have made an argument that's the death knell of search, but it hasn't been the case.
It hasn't been the case, and half of search comes from small businesses. They're never going to move to a ChatGPT search for years. They're going to stick with Google. It's not the death knell for social. What we're worried about is the open internet, long tail of publishers, where we think this completely undermines their business, and what they should do is they should license their content as fast and as often as possible with these AI platforms and take that money and pivot to event businesses, to subscription businesses, and move away from advertising.
What about on the provider side? My buddy Mark Douglas runs a company called Mountain, right? They got together with Ryan Reynolds on the creative side, and now they have an AI program that allows small businesses to create their own advertisement and then aim it at the right people in their region.
Yes.
Seems like it should be a slam dunk.
Small business, CTV, B2B, CTV, these are a lot of spaces that didn't really exist a few years ago. And now, because of some of those AI tools, the creative barrier has dropped much lower. And everybody wants targeted advertising. Everyone wants targeted on TV. And so those are definitely some growth areas. But overall, if you zoom out to the total TV landscape, it's not growing. It's not growing the pie. And that's why we're seeing consolidation, because when the pie stops growing, everyone starts battling over taking share.
You know who gets paid here? David Zaslav, the CEO of Warner Brothers Discovery.
Yeah, he looks like a genius right now.
He does. I mean,
and he looks like a defender of the creative community. He's starting to look like a man of the people.
I tell you, the best trades in media over the last 15 years have been sales. I mean, Larry Mays in the radio business, Rupert Murdoch in the big diversified, media empire. Now maybe the Zaslav and John Malone, all those guys, boom, they said had enough. Now it's up for some of the new technologies. When does Google spin out YouTube? Wouldn't that be great?
The thing about YouTube,
former banker.
Yeah, I think YouTube is core to their business.
Yeah.
The thing is, though, advertisers don't think of YouTube as TV, but consumers think
Absolutely.
of YouTube as TV. Consumers even think of social video as TV more and more. So if you look at how TV broadcasters are positioning themselves, they're still going after the old story. We have brand safe, the most premium content, the live sports you want. Digital platforms have that. Thursday Night Football is on Amazon. The Oscars is going to YouTube. The landscape is shifting, and we're not seeing the kind of investments in content or investments in global solutions that we think we'll need to see for those to turn the business around.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
AI, obviously, the driver of last year, the year before, and really the year before that, driving demand for cybersecurity as well, as more industries adopt the technology. And Bloomberg Intelligence says expect more cyber spending and consolidation in the sector. Let's discuss that with Theresa Payton. She's the CEO of Fortalice Solutions. She was the White House Chief Information Officer, the CIO of the White House under George W. Bush. Theresa, thanks so much for joining us. How important do you think cybersecurity will be in 2026? I feel like I just can't overstate the importance of cybersecurity in an AI world.
Yeah, thanks for having me here on a happy New Year's Eve. And yes, I'm predicting everyone needs to get ready for a new wave of attacks that we have never seen before, because cyber criminals, as we get better at cybersecurity, they don't give up and suddenly say, gosh, maybe I should be a good person because they've made it harder for me now. They just up their game. And so be prepared with AI, I think quantum computing could be available by the end of 2026. And quantum computing is going to be incredible for solving the previously unsolvable problems. But that also means for cyber criminals breaking encryption.
So is quantum computing, I'm not sure if it's friend or foe here in your world of technical security. How do you think about it?
Well, as sort of, for mankind, quantum computing, if we do it right and get it right on sort of the environmental impacts and issues, is going to be incredible. It's going to allow us to solve problems that we haven't solved before because massive amounts of data, volumes, mathematical problems, and we truly will see breakthroughs, I believe, in healthcare, protecting the environment, and a lot of other issues on everybody's minds. However, in the wrong hands, it's a tool. And so the tool is neither good nor bad. It's just how is it wielded? And in the wrong hands, this quantum computing tool could be used to sort of do decryption on previously stolen data that has been encrypted based on yesterday's and today's standards. But with quantum computing, it's no longer safe. So if you think about nation states and cyber criminal syndicates who have been stealing data for the last 10 to 20 years, and people have said, gosh, they're just sitting on it. They haven't done anything with it. When quantum computing comes, they may actually be able to weaponize it.
When is that? A lot of people talking about quantum computing these days. I'm watching the stocks. Most of them have not done well this year, but it's coming, right? I remember when Jensen Huang said it's 15 years out, and now he was like, well, maybe more like 5 to 10.
Yeah, based on what I'm seeing, there's been some incredible breakthroughs in several labs around the world. And this is a global race as to who's going to figure out quantum computing first. And based on what I'm seeing, I really do believe it will be commercially available by the end of 2026. We've been saying in the next 2 to 3 years for over 3 years now. So I really do believe, based on what I'm seeing coming out of the lab reports, it will be available probably only to those with the deepest pockets will be able to afford quantum computing at the end of 2026. And then we'll see it become more commercially available 2027, 2028.
I should amend my issue a surveillance correction, because I'm looking at the Defiance Quantum ETF, and it actually is up 37.5% year to date in terms of total return. So it has done quite well.
Theresa, as we think here, what are the risks that we're not even thinking about yet? I mean, it just seems like every time I see a hacking story, it's like, I never even would have thought of that. But there it is here. Are there some things that are really worrying you in the back of your mind?
Yeah, I think if you sort of look at my top 5 list of things I'm worried about going into 2026, one is around the various AI implementations that have been happening. The lack of governance and guardrails also means that things are going to market and it may not be secure by design. And we're going to find out the hard way where the security is lacking in these different platforms. I think the second thing that I'm concerned about is, again, AI is going to be an incredible tool, a great productivity enhancement for a lot of businesses. It's going to democratize data, so you no longer have to be the largest company with the best data scientists now to be able to actually leverage and monetize your own data. But with that powerful tool comes, responsibilities, and it could end up in the hands, we've already seen this year, of cyber criminal syndicates trying to use it to create malware, to create ransomware, to create different types of attack vectors and take advantage of where we've missed out on secure by design in our software stack.
Hey, you served, Theresa, in a Republican administration as CIO under President George W. Bush. What do you think of this Republican administration and its effects on cybersecurity?
Well, I'd like to think that regardless of party, that the United States has dedicated public servants in all the departments and agencies who are very focused on security by design.
But sometimes we fire all those dedicated public servants and replace them with Fox News hosts. So what do you think there? How would you grade them?
Well, what I would say is I would focus on the cybersecurity strategy for the administration. If I were advising them, I would tell them you need to give a clear and consistent message. You need to let people know who's going to be in charge. We still, have an acting situation over at DHS with cybersecurity. And I would say the things that you are keeping that are good, and then the things that you are changing to reflect the changes in our modern technology infrastructure. A lot of the things that we are doing the last 10 to 15 years are not necessarily going to serve us. So it has been a very challenging time for many of the people that have been impacted by the layoffs in government. But we need to look at an opportunity to say, who wants to do public service and what do we need to do next with all of this new technology that's being implemented, not just in the departments and agencies, but also in our critical infrastructure, which really needs attention.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This week marks the end of an era for the man that many regard as the world's greatest investor. Greg Abel will succeed Warren Buffett at Berkshire Hathaway in the new year, taking control of a $1 trillion conglomerate with more than $350 billion in cash on hand. I don't know what you do with that. Let's discuss with CFRA research analyst Kathy Seifert. Kathy, let's start with that big slug of cash that's on the balance sheet. It's been there for a long time. They've shown an inability to put that to work here. What do you think the plan might be under Mr. Abel?
Well, I think this year is going to be a transitional year for the company under Greg Abel. And I think some of the steps he's recently taken have sort of shown that. With regard to the cash pile, some of that cash is being held to support insurance liabilities. So I don't think investors should think that that cash is all going to be deployed into acquisitions or what have you. I know given Warren's investment style and value-oriented approach, the sense that I had was he was sort of frustrated with valuations. He was having a hard time finding, good uses for that cash. My sense is as we head into 2026, there may be some pressure on Greg Abel to potentially pay a cash dividend with that, or possibly put forth a more structured share buyback program if they're not going to deploy it into acquisitions.
What could they buy with that much cash? Is there anything that you could think of if you were in charge that you would try and pick up?
I don't think my compliance folks would like me to speculate on who they might buy. But I think if you look at the Berkshire operating model and you look at the framework, the investment portfolio is sort of barbelled between financial services and technology. And those are names that they like to own as an equity investor, not necessarily as an operator. So, I think if we look at Greg Abel's background in energy and industrials, my sense is that he may tilt in favor of those businesses, which makes sense given what's going on with some of the industrial and energy build out to support AI. And then I think the other area that probably makes sense to look at is the insurance space. It's a significant business segment for Berkshire, and insurance pricing is softening. And when that happens, typically you see an increase in M&A activity. They have in the past added to their stable of companies through acquisitions. I wouldn't be surprised if they do that going forward.
As a non-Warren Buffett acolyte, my first question would be, he can't find any investments. That's clear. Why does a company not return that cash to shareholders via that dividends and or buybacks?
That's a good question. And my sense is that Warren Buffett was given a certain level of grace and leeway that Greg may not be given. And there may be a cohort of investors who do agitate for a return of some of that capital. I would not be surprised to see that.
Hey, you're getting some blowback in the live chat now, Paul.
I know.
And you're a dividend guy, I get it. But these investors that are watching us on YouTube say they better not create a dividend, completely wipes out a segment of investors. We do not hold Berkshire looking for a dividend. I invest in Berkshire because they're better with money than I am. And they make some good points here. So, Kathy, I guess a buyback makes more sense if you're going to try and return cash, right? If you think Berkshire shares are undervalued.
Well, but that's the interesting thing is that they haven't bought back any shares in over a year. They didn't buy back any shares this year. And so not buying back shares, you have a situation where I believe the Warren Buffett premium is being extracted from the stock. There is not necessarily a significant acquisition plan out there. And then the other pressure is a lot of that cash is invested in Treasury securities. And if Treasury yields continue their current trend, we would likely see investment income coming under some pressure. So, there may be, maybe not the people on the Bloomberg chat room, but there may be some large pension funds who are not on the Bloomberg chat room, who may have a different feeling given, where the company is, given the position of the company, and given its growth prospects, which have not been particularly stellar, particularly on the top line.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.